Hey guys, OPSEC here and welcome to the 5th episode of the How to Trade series. So in today's episode, we're going to be going over types of passive order flow, types of active order flow, and then some examples on the charts. Okay, so what you can see over here, right? Let's begin with this. So types of passive order flow. Passive order flow would be a limit to enter a trade typically. Okay, typically it's a limit to enter a trade. However, sometimes you may use it to close a position. If you use it to close a position, that tends to be at a take profit level and not at a level where you get stopped out. Reason for that is because I will go over that why after we go over the active order flow. Active order flow, which is market order, tends to be stop losses and manual entries. I'll tell you why. A stop loss, if you have this level and you don't want price to get under this level, and if it does, you want to be out of your position. If you sell a limit order exactly at this price, nobody guarantees that there's going to be somebody who wants to buy right over here. If you want to sell right at this price, nobody guarantees there's going to be somebody who wants to buy from you. Price may just keep going down and the buyers may be waiting down here. You know what I mean? So if you don't have a market order here, you're taking the risk that there may not be a buyer who is willing to match that exact price, and price will just continue dumping on you until you get liquidated. That is why we use stops, market orders, on invalidation, right? So if price gets under your level, you are for certain going to get out. It's not always going to be the exact price you want to get out at, but at least you're not going to risk liquidation. Okay, you're going to make it less likely. Okay. So, and why on a take profit may we use a limit? Because let's just say you want to take profit over here. This means you want to sell up there. Okay, you have a limit to sell up there. If price actually manages to push above this, that means there's somebody buying out all of the sell limits that are scattered all along here and here, right? If price pushes up to those areas. So you're just going to be along those sell limits and you're going to get filled in for sure. But as price is moving down, right, because here people are buying it up. As price is moving down, people are not buying it down. They're selling it down, okay? The banks at least. They're not buying it up. They are not buying it down. They're selling it down. And that is why you don't want to risk not getting filled on your limit down here. You want to use a market order. Now, anyways, let's get into some examples. So over here I drew a chart, right? Here's a price of 10, 11, 12, 8.5, and 5. Okay, now as you can see, I drew out some asks and some bids. Asks as in sell, bid as in buy. Okay, so as you can see, there is a 100 contract bid at 8.5, and there is a 50 contract bid at 5, and then at 11 there is a 100 contract sell, and then a 200 contract sell at 12. Okay, so now the current price is at 10. Why? Because that is the last traded price. This is 10 would be the last price where there was a participating buyer and seller. What do I mean by that? What I mean by that is, let's just say there was a limit over here. Let's just say it was 200 contracts at 10. Somebody of the active order flow went ahead and bought that out, and that is why price is currently at 10. And now that limit moved over to our active order flow chart, right? This is our passive order flow chart. Let's just draw an active order flow chart. Here's going to be our active order flow chart. So this got paired. This 200 ask at 10 got paired with a 200 ask with a buyer over here. Okay, so somebody sold and somebody bought here, and that is why price is currently at 10. Here's the last traded price. Okay, this is our active order flow down here, and then our passive order flow up there. This is why price is currently at 10. If I want to move, now here's my question to you guys. If I wanted to move price from 10 to 11, what do I have to do? How many contracts do I have to buy for price to move over to 11? Pause the video right here and take a second to think about it. I'm gonna tell you right now. So to move price from 10 to 11, all you have to do is buy one contract. Yes, you heard that right. One contract. Why? Because after you buy one contract, what happens is this limit from 100 goes down to 99. And then what happens here would be something like this. 1x. One contract was bought at 11, and one contract was sold at 11. This is our active order flow. And then price moves over to where? Price moves over to 11. Okay, so price started at 10, and then it just moved to 11 with one contract. Okay? Now, if I want to move price to 12, how many contracts do I need to buy? Take a second, pause the video, and think about it. Okay, if you thought about it, the amount of contracts you gotta buy now to move price to 12 is 100. Huh? Why 100? Then it just take us one contract to move price from 10 to 11. The reason we could move price from 10 to 11 with one contract is because there was no resistance in between. But now the resistance to 12 is this 99 contracts ask from 11. So if we want to move price to 12, we're going to have to fill in this limit. So we're going to buy 99 contracts, right? And now this is going to be at 100, right? So it's going to look like this. There's going to be now another trade. There's going to be another trade of 99 here and 99 here. And now the resistance between 11 and 12 is gone. And now one more contract would bring us up to 12. So now if we go ahead and buy one contract, then it's going to sell that to us at, It's going to sell that to us at 12 because that is the nearest seller. The nearest seller is now at 12. So now from here, price has moved all the way up to 12. With one contract, well, with 100 contracts overall. Okay, and now this turns into 199. Okay, now, how many contracts would it require for me to move price from here all the way down to 8.5? For me to move price all the way down to 8.5, it would only require one contract. And price would dump down all the way to 8.5. Why? Because there is no resistance between 12 and 8.5. There is a hole in the books. There is no liquidity in the books between 12 and 8.5. So what happens? This turns into 99. And then boom, boom, we have a new trade in the active order flow, which is 1x at 8.5. And now this is our current last traded price. So what you just witnessed is how you can move price. This is how price moves. How you can move price regardless of the volume. Price moves regardless of money. You heard that right. I can change the market cap of a certain asset from 100 billion to 100 trillion with less than a million, with I'll tell you, with even $1, the way you can do that is if you open a company and you distribute 100 million shares. Okay, so if I distribute 100 million shares and then I set a sell, so let's just say I opened a company and they distributed 100 million shares, okay? Now, if I trade one share, right? If I set a sell limit does one share at how much would we need to get a trillion, right? We gotta multiply that by 4 more zeros. So if I sell one share for 10K, so I put a sell limit, one share at 10K. Now, if I buy that from myself, so if I see that sell limit, it's now on the books. And now if I click market buy, so if I click on market buy, it's gonna pair with this and I'm gonna get one share for 10K. So this means 10K went out of my pocket, but 10K came back into my pocket. So for effectively nothing, I made one share. According to this, I made one share worth 10K because that is the last traded price. Now, this does not mean that the market's actually going to buy this. Okay, it does not mean that. It just says that the price tag is going to be 10K per share with a $1 trillion market cap. Okay, so the market cap of an asset does not mean its actual value. Okay, now how does this make any sense, right? Take, for example, pump and dump schemes. Have you ever heard of pump and dump schemes? If not, I will tell you what it is. It is when influencers do this. They create a crypto coin, and then they trade with themselves to inflate the price to something that it's not actually worth. And then there's nobody that's willing to buy that price, so they can't unload their shares over that price. So what they do is they tell their followers, hey, go buy it at this price. It's worth so much, right? And then their followers come in and buy, and then they sell to them, and then price goes to its actual value. Okay, this is very illegal, but it actually happens. If you look up pump and dump schemes, you will see. I can show you an example right now. There's one called Costa from the Moon Carl. Like, let me show you. It's a token. It started at a certain price, and it just took a nosedive ever since. The reason why is because obviously they unloaded all of their shares to their followers who were willing to buy at a high price. Let me show you Costa. Let's see if I can find it. Costa USDT. There you go. Right. So notice this. How did it start at this price? And ever since it started, it's just going down. How is that possible? I'll tell you how it's possible. They advertised it at this price. Okay. They advertised it. It started at this price. Right. Everyone came in and started buying. And what they did was that what they would do is they would just have sell limits allowing the sellers. Anyone who comes and buys, they will just provide infinity liquidity from the sell side. So they'll just provide infinity liquidity from the sell side. So whenever their followers are buying, they're getting paired with them. And then eventually when they're about to get rid of their shares, here, like for example, right over here, you see, why did price come up to this particular point? Because that's where they had their sell limits. Okay. And yeah, and then they just fucking scammed their followers. This is why it went down by like 97%, right? Isn't it crazy that NASA loses 96% of its 96% of its value? The reason this is possible is because they advertise it at a price that is not actually worth what they're advertising, and they leverage that, right? How come it was worth this price? It's because they decided it is. They set a sell limit here, and they bought from themselves. That's why it was worth this much. Okay, and then when the retail came in, then they sold to them and they distributed their shares. Now let's analyze this price action. Notice this price action. You see these big moves. This is not something you should trade, but this is just good for learning market making. You see these moves. Why are these moves so fucking crazy, right? It's fucking 20% move in one candle. Why? How does this happen? I'll tell you how these moves happen. The way these moves happen is because these types of coins have no liquidity. So if I set a buy limit here, it's likely that price is just going to wick down to it eventually when somebody clicks market sell and there is no more resistance, right? So what happened was there was no more resistance between this price and this price. And then somebody clicked market sell, or we hit a stop loss, and then that stop loss triggered the market sell, right? Because this is a low, it's likely it has a stop loss. This stop loss triggered a market sell, or something triggered a market sell, and then those sells, there were no buy limits for them to get paired with, and then the nearest buyers were all the way down at this price, and that is why you see price do all of these crazy fluctuations. Why is that? That is because there's no liquidity, so there's not much resistance, and that is why you see all of these crazy moves. Okay, so on a coin like this, it's likely that if you just sell a limit over here, you'll get filled soon enough. Okay. Anyways, back to our example. Now, up until now, I've explained to you mainly passive order flow. I've explained to you how to read the passive order flow. I've not explained to you how to read the active order flow. How do you read active order flow though? You can't see it, right? It just pops up. I'll tell you, you can't see it, but you can anticipate it. I'll show you how. Market makers are gonna think with retail logic to understand retail. And by doing so, they understand where the active order flow is likely to rest. Okay, I'll show you. This high up here, it says likely that retail is viewing this as a bearish market structure break, meaning that this high contains what? Buy-side liquidity. What do I mean by buy-side liquidity? I mean buy stops, active order flow of buy stops. Why buy stops? Because if you're in a short position, we covered this in the first video. If you're in a short position, then your stop loss is going to be a long. Okay, because to close your short, you have to open a long. We covered this in the first video. Go and watch it if you haven't. Your stop loss is going to be a long, which means when price gets above this, you are buying. That's why it's called buy-side liquidity. So market makers are going to anticipate that if price gets above this, a lot of people are going to now be buying. All the people who sold in these areas are going to be buying over here. And that's going to be an opportunity for them to sell to those buyers at a high price. Okay. Now, this goes very deep and very complex, right? This is a very deep and very complex topic already that we're tapping into. So I'm going to try and maneuver around that. Right? If this doesn't make full sense to you, it shouldn't, because you are not going to fully understand this. It should make some sense to you. Then that's fine. Okay? Anyways, what the market makers are going to anticipate is that if they start buying, price is going to move right to the point of interest of the retail. Retail is going to likely be interested at the premium. Okay? So this line over here differentiates between the premium and the discount. So retail is likely going to be interested in the premium, so price is likely to draw into here. Once it draws into here, the market makers are likely to continue buying and hit their stops. And when they hit their stops, what the market makers do by doing so is they're realizing their profits from manipulating price up. What do I mean by that? I mean that to get price up to here, the market makers had to buy at all of these prices. And then, if they want to take profit on these positions entered over here, then they have to sell. Now, if they want to sell, they got to find a buyer at a high price. Who is that buyer? That is this active order flow. So what the market makers are likely to do is they're likely to set sell limits, right? Because they bought here, so now they want to sell. They're likely to set sell limits just at or slightly above this buy-side liquidity. And then all of the active order flow is going to get paired with their sell limits, and then they can continue moving price down with little resistance. Okay? So this is, I think I'm going to stop the video here because I'm already starting to pump in too much information into one video, which I don't want to do. So over here, you witnessed three main things. One, you witnessed how price can be moved regardless of volume. Price is a scam, okay? So the price market cap of a certain asset is not its actual value, okay? That is not its actual value. The way to determine an actual value of something is, for example, I'll give you an example. Let's just say virtual companies have an 8 times multiplier on their annual profit. So if this business can make you 100K a year clean, it's worth 800K. Okay, that is an actual value that we can all agree on, because if you buy this business, that's going to give you passive cash flow of 100K a year, and that's worth 800K. That is something society has agreed on, and that is an actual value. Okay, but as for a market cap of a certain asset, that's a total scam, because that can be booked. That's booked by the exchange rate, and the exchange rate is manipulated by money. So if you can manipulate the exchange rate, then you can manipulate the value of said thing. And that is why it's a scam, because the banks can manipulate it. Okay, so you learned why price is a scam. Price can move regardless of amount of money, right? It's not like that. And you learned how the order books function, okay? And you learned a bit more about passive and active order flow, okay? And you learned how banks can accumulate positions, like here they can accumulate, and here they can take profit. And after they take profit, where price will go after that, that is dependent on the context this is within, okay? So I'm gonna call it a video here. Make sure you like, subscribe, turn on the bell. Peace.